Welcome to The Explainer. If you're brand new to the world of Forex trading, well, consider me your personal mentor today. We are going to break down the absolute core engine of the foreign exchange market. And look, if you only remember one single idea from today's lesson, make it this. Interest rates move currencies, and inflation decides exactly where those interest rates go. If you can understand that relationship, you understand the beating heart of the global markets. Real quick, here's our roadmap for today. We're going to cover the reality of inflation, the central bank speedometer, the currency chain reaction, trading the news day, and finally, your very first trade review. It's a clear, step-by-step blueprint designed to give you total confidence before you ever place a trade.
Section 1. The reality of inflation. Let's take all this high-level economic theory and ground it in something you actually experience every single day.
Because inflation is actually incredibly simple. Think about your standard weekly grocery run. A basket of daily groceries from 5 years ago, compared to the exact same basket today, it costs noticeably more now, right? I mean, that is inflation in a nutshell. It simply means the prices of everyday goods and services are rising. And as things become more expensive, your money is actively losing its value. You literally can buy less milk and bread today with the same $10 bill than you could a few years ago. So how do traders and economists actually measure this annoying grocery bill increase? Well, they use something called the Consumer Price Index, or CPI. Whenever you hear traders talking about CPI data, they aren't trying to sound overly complicated. They're literally just talking about a standardized measurement of how fast those everyday prices are rising. It is the absolute primary tracker for inflation.
Moving right into Section 2, the central bank speedometer. We know what inflation is now, but let's talk about who is actually in charge of controlling it. Enter the central banks. I love this analogy because it brilliantly illustrates how the whole system works. I want you to imagine the economy is a car. The CPI, that measure of inflation we just talked about, is the speedometer right there on the dashboard. The central bank, so like the Federal Reserve in the US or the European Central Bank, they are the driver. Now, the driver wants to keep the car cruising at a nice, safe speed, usually aiming for a target inflation rate of around 2%. But if that CPI speedometer starts climbing way too high, indicating prices are rising too fast, the driver has to act. So what do? They stomp on the brakes. And in the economy, those brakes are interest rates. Raising interest rates slows down spending and cools off the entire engine.
So the crucial takeaway is summarized perfectly right here. CPI tells the central bank what to do. The central bank tells the currency where to go. Seriously, write this down, take a screenshot. This is the golden rule of Forex. You aren't just trading random lines on a chart, you are trading the reactions of central banks to inflation data.
Which brings us to Section 3, the currency chain reaction. Let's map out the exact mechanical sequence of events that drives market movement.
This is the specific flowchart you really need to master. Step 1, the CPI data is released to the public. Step 2, the central bank assesses that data to see exactly how fast the economy is moving. Step 3, based on that CPI reading, they make an interest rate decision. Do we raise rates, cut them, or hold them steady? And finally, step 4, the currency moves based on that interest rate decision. So it goes CPI to central bank to interest rate to currency. Let's look at the two main ways this chain reaction plays out. In scenario 1, we have high CPI, meaning high inflation, so the central bank initiates a rate hike to cool things down. Well, higher interest rates attract foreign investors who are looking for a better return, and that sudden demand leads to a stronger currency. Now, in scenario 2, if we have low CPI, the central bank might trigger a rate cut to stimulate the economy. Lower rates mean less return for investors, which leads to a weaker currency. This reaction right here, this is exactly what you'll be trading. All right, Section 4, trading the news day. Let's shift from all this economic theory to the practical, sometimes crazy reality of what happens on the trading floor when this data actually drops. This is the timeline of a typical CPI news day. It starts off with pre-market anticipation. The market is basically just holding its breath. Then, the exact minute the CPI data is released, total chaos erupts. You'll see a huge volatility spike on your charts. Price will whip violently up and down in a matter of seconds, creating what we call liquidity grabs, where early or poorly placed trades are just completely taken out. Finally, once the dust settles and the market actually digests the numbers, a brand new intraday trend begins. This is the true heartbeat of a high-impact news event. Now, here is a nuance that so many beginners miss. Trading CPI isn't just about the raw inflation number itself.
It's actually about comparing the actual CPI numbers to the forecasted market predictions. Before the release even happens, economists publish a forecast. If the actual CPI comes in higher than that forecast, the currency usually strengthens, because the market is suddenly anticipating a rate hike. But if the actual CPI comes in lower than the forecast, the currency weakens. The market already prices in the forecast ahead of time. You are trading the surprise.
Because of those sudden surprises, you need a strict pre-news checklist. Before the news hits, check the forecast versus the previous month's data. Post-release, immediately compare the actual number to that forecast. But most importantly, especially as a student right now, be aware of that huge volatility. Expect those massive liquidity grabs. CPI days create big, exciting moves, but they also carry massive risk. Honestly, a lot of professional traders will literally sit on their hands during the exact minute of the release and just wait for the new trend to clearly form. Section 5, your first trade review. We've covered the mechanics, the psychology, and the risks. It is time to test your readiness before you tackle the live markets. Let's do a quick review.
Quiz number 1. Imagine you're sitting at your desk. The US CPI data drops and it comes out significantly higher than the economists expected. Based on what we've learned, what does the market expect the Federal Reserve to do? Think about the car speedometer for a second. Quiz number 1. Imagine you're sitting at your desk, the US CPI data drops, and it comes out significantly higher than the economists expected. Based on what we've learned, what does the market expect the Federal Reserve to do? Think about the car speedometer for a second.
Let's move to quiz number 2 and see how this builds into your charts. Because the market expects the Fed to raise rates, global investors start aggressively buying the US dollar to get that higher yield, so the US dollar gets very strong. What happens to the currency pairs Euro USD, GBP USD, and gold? Well, since the US dollar is the second currency in those pairs, which is the quote currency, a stronger dollar actually pulls the whole chart down. So Euro USD falls, GBP USD falls, and gold, since it's priced in dollars, often falls right along with them.
So your crucial takeaway is captured right here on your final cheat sheet. This is the unbreakable relationship between central bank actions and currency strength. Rate hikes equal a stronger currency. Rate cuts equal a weaker currency. And what actually causes those hikes and cuts? The CPI inflation data. That is the engine.
We've covered a ton of ground today, all the way from the grocery store checkout line to global central bank policy. You now understand the fundamental mechanics that drive the largest financial market in the entire world. So my question for you is this. Armed with the knowledge of how inflation and interest rates dictate the flow of global money, are you ready to trade the next big CPI print? Keep this explainer handy, stick to your checklists, and manage your risk. I'll see you in the markets.